I think we should make a start. Anybody else who joins in will just have to play catch up. Oh, we still got quite a few coming in, the late arrivals to the class. All right then, let's kick things off. I'm going to start off just with a couple of housekeeping points. Thanks for joining us, first of all. Everybody, I think, has already done so, but please just make sure that your microphone is muted, just to make sure that you're not popping up and presenting to everybody. Keep it all nice and clear and quiet. We are going to be recording today's session, so just wanted to put that out there. If anybody is uncomfortable with that, then obviously feel free to leave the call. Also, we're going to be asking anybody to, with any questions as we go, to write them in the chat feature that's over on the right-hand side of this box. So we've got somebody who's got a issue with being unable to hear at present. Daniel, can you hear me okay as a test?
I can hear you fine.
Okay then. So Joshua, that might just be something your end, I'm afraid. If you've got any issues there, we can send you out a recording of today's webinar afterwards. All right then. So as I was just saying with the questions, using the chat feature over on the right-hand side, you can ask any questions as we go through today's presentation, and then we'll be answering them towards the end of the session. And if there's a lot of questions, we can always follow up with those afterwards. So I think first things first, let's do a bit of an introduction. I'll start with myself and talk about Aprao, and then I'm going to hand over to Daniel. So my name is Daniel Norman. I'm the co-founder and CEO of Aprao. We are a cloud-based financial modeling tool for real estate. Put simply, we are a cloud-based tool for property development appraisals. We are going to be talking today through a development appraisal, but also looking at it from a funder's perspective and what a funder is going to be looking for. So my background prior to starting the company was actually as a lender for 10 years. I started my career working for a mezzanine lender, and whilst lending mezzanine, I was doing a lot of deals alongside close brothers, and in particular Daniel Joyce. So this is an appropriate time for Daniel to give us a little intro, because we've known each other for 10 years. So I'll hand you over to Daniel now.
Okay, thank you, Daniel. Just a quick intro to myself. I'm a director within the property division of Close Brothers, where I've actually been for 20 years. In terms of Close Brothers, we're a leading UK merchant banking group, providing lending, wealth management services and security trading. We're FTSE 250 and employ over 3,000 people. So it's a pretty big entity. In terms of the property division specifically, we've been lending on property for over 40 years through the various cycles, and been supporting many developers throughout that period of time, delivering residential development finance, as well as some high yielding investment and pre-sold, pre-let commercial opportunities. So over the years, I've seen quite a few appraisals, both coming directly from the developer, but also from the broker network, and they can be a real mishmash. So seeing what Daniel and Aprao are doing at the moment, is a breath of fresh air in terms of trying to standardise that model. And what I like about it is going to hopefully make my life a bit easier.
Well, that's exactly what we set Aprao up to do. So just to give everyone a bit more detail of what we're going to be doing today, we're going to be running through an actual appraisal. It's a made-up deal before anyone tries to jump in and buy the site. It's a fictional address and fictional numbers, but basically we're going to run through a deal. And we're going to be asking Daniel some questions around. This can get confusing with two Daniels, but we'll be asking Daniel Joyce some questions. I guess I'm not going to ask myself a question around how he would approach it from a lender's perspective. So I'm going to be sharing my screen, so just make sure that you can have a clear vision of that. And so without further ado, let's get into this. I'm going to share my screen now. So here we go. Right, just as a test, Daniel, are you able to see this? It should be up on your screen now.
Yep, I can see it fine. Thank you.
Perfectly. All right then, brilliant. Right, well here we go. So this is a little preview of our dashboard. This particular dashboard doesn't have too many projects on, but it lets you customize how you are looking at your projects. So I know we've got some customers on this call as well as prospective customers, so our customers will know that you're able to easily customize these headings to suit your workflow. I've just got these set up as sites under review, sites that are under option or in planning, or live projects. And as a site progresses, you're able to move these around and progress them through those stages to allow you to track and manage all of your sites clearly and easily from one place. So this is a project I started. It's, as I say, it's just an example project for 6 4-bedroom houses and 2 5-bedroom houses in Surrey. So we can have multiple versions of an appraisal, and this is the interface that all of our customers have. So you're able to run unlimited versions of an appraisal, multiple variations. It's very easy to do so. So I've got an initial appraisal here, and then this one here that we're going to use for the purposes of securing finance. So I'm going to click into this, and immediately what you can see is over here on the right, we've got some key metrics, which are the key project metrics like return on cost, return on GDV, etc. And then we've also got the summary financial appraisal, which is always visible here. And then we've got a little tool for the residual site value, which we'll come on to in a bit. So this is our finance appraisal, and we've got a little summary of the development. The first thing we're going to do in this site is we're going to start with sales information. So on this site here, we've got a mix of 4 and 5-bedroom houses. So I've just added these into the appraisal very simply using our quick add tool here, where we can bulk add a number of units into the appraisal. And this is our mixture of 4-bedroom houses. So what we've got here is a breakdown of the units. We've got our associated costs for the sales, like sales agents fees and sales legal fees. And then we've also got the other unit type, which is the 5-bedroom houses that are here. So we break it down by unit type, but you can have as many units and as many unit types as you would like. So what I want to do at this first point is bring Daniel into the conversation. So when you're receiving appraisals, Daniel, from developers, what are you looking for when it comes to the sales information and the units and the values associated with those?
As a starting point, it's having a breakdown of the individual units. It's quite often that we will receive an overriding GDV. So we'll be told the GDV is circa £7-8 million. There's 20 units, but we know a particular breakdown. So having that specific breakdown in terms of amount of bedroom, more particularly the square footage, is very useful for us, so that we can sort of align and break down the unit sizes, the unit prices, and then what we'd like to see really behind that is a square foot rate per square foot, and then some backup information to go with that. So it's evidence of comparables in terms of stuff that's sold, stuff that's still on the market. And if your specific site is sitting outside of those boundaries, it's really about ensuring that we have the justification for that. Now, that may well be, this is a special site in a location. It may be the specification is going to be higher than what's already on the market. But, the reality is we want to see a breakdown and then some sort of background information to back up the numbers in the appraisal.
All right, thank you, Daniel. So yeah, as you can see here, on bringing that back to what Daniel was saying, we've got an average pounds per square foot per unit type in the mix here. So you can very quickly and easily see what those pounds per square foot are. The average, you can see the individual unit values. And if you are making tweaks or adjustments to your appraisal, you can easily just jump in and change the the square footage for an individual unit, which has a knock-on effect on the pounds per square foot. Equally, you can just change the pounds per square foot as well, and that will change the value. So everything within here, whilst we have a very quick and easy to use tool, is fully customizable for that full breakdown. So you can get that accurate information across when you're presenting that to your lender. Next thing then we're going to move on to is the build cost for these units. So we break ours down into what we call phases. I've broken this into the build for the 4-bed houses and also the build for the 5-bedroom houses. We also have the ability to input preliminary costs into here, and we can put in as many costs as we want, and we can rename the costs and add them in the mix here. But for today's purposes, we're just going to be focusing on the build. So for the 4-bedroom houses, we bring the square footage over from the sales information. I actually just added a bit of square footage on 100 square foot on, so you can see we've got a little bit of extra square footage here. So I'll just bring that into the appraisal using that. And for each of these units, I've just assumed a third-party contractor to keep things simple with a headline build cost. So we've got £180 per square foot, and this is calculated on the GIA to build the 4-bedroom houses, and on the 5-bedroom houses, it's £185 per square foot. But should you want to go into a full build cost breakdown, you can easily do that, and you can add in as many line items as you want, and you can add as many phases as you want. Within this as well, you're able to add a contingency per unit type or per phase. And also we can customize the NIA or the net area and the gross area either by typing in or changing the percentage and the net to gross ratio. So coming back over to Daniel on this, when someone's sending you information around the build cost, what is important for you to look at and what do you want to see?
Yeah, it's not too dissimilar to the sales figures, to be honest, Daniel. You know, it's important for us to see a bit of a breakdown. So we've already seen a breakdown of the units in terms of the square footage, etc. So when we come to the build side of things, firstly, we want to understand, is it going to be a third-party contractor? You know, Daniel said in this example it is, or will it be self-built? Because that will have an impact clearly on where the costs are going to come out on a pound per square foot rate. And then we are specifically looking at where you are in terms of that pound per square foot rate, and then we will align that with the quality of the houses that you're looking to deliver. You know, the reality is you're not going to deliver a circa £1 million house at £50 a square foot. You know, we've been around long enough to appreciate where build costs should be expected. So having that breakdown gives us a quick overview of where you are and whether we think those are reasonable. You know, if they sit outside our levels or what we think is reasonable, we will then ask for some form of explanation as to why the client thinks that they can deliver at those sort of levels. Because ultimately, from our perspective, the risk really is, you know, it's in the land, it's in the build, but we ultimately, as a lender, we want to ensure that there's sufficient allowances within the facility to deliver that scheme. So if the build costs are too light at the outset, we know that we're going to be heading towards a cost overrun quite quickly. So we can get it dealt with now and assessed now, and you know, and if we can assess it in the sort of pre-terms situation, it makes our life a lot easier, and you know, it sort of helps in terms of that sort of sense check for us. But ultimately, in any sort of lending scenario, it will be overviewed by our PMS. So whilst this is a starting point and it's going to get the breakdown, you know, it will, this information will go over to our professionals in any event.
Okay, and what about contingency? Have you is there something you would expect? Do you normally see a contingency in from the developers?
Yeah, without doubt, and they can range from anything from, you know, 3% up to 10%. I think any developer going into, particularly today's world, going into a scheme without contingency is probably, you know, they're sort of heading towards potential cost overrun at the outset. You know, we all know that during the life of a scheme that there will be issues that, you know, it probably won't necessarily run to plan. So I think we would always have some form of contingency in there. The level can be determined depending on the type of scheme.
Okay, that's fine. So as somebody sending you a project, is there a typical average? Like, would 10% be like what you would expect to see, for example?
Yeah, I think so. Yeah.
All right.
That's a fine figure, but as I say, it really depends on the type of project.
Perfect. All right, that's great. Well, that's very useful. Let's move on then to what we classify as other costs, but this is really a catch-all for any other costs in the project. So we have these cost groups here. So you can add a group, and then you can add as many costs within that group as you want, and you can also label those groups as you wish. So I've got a couple here. I've got the professional fees, so with the architect's fee, the engineer, the QS, for example. We've also got some statutory costs or some local authority costs with the Section 106, the SIL, and some planning related fees. Looking at the fees, Daniel, is there something that you would want to see from this, or is there any kind of any top tips or highlights that you would recommend to developers?
I think it's just making sure that the figure's as full as possible. I mean, you'll probably find that by the time you get to borrowing money, you may well have quite a lot of professional fees already. So a decision has to be made whether you want that to be included in your funding package or that's going in as your equity. But I think like any of these numbers, the fuller you can make them or more or as accurate you can make them now, the more feasible your scheme or more confidence it will give us moving forward. You know, it's important to make sure you've got your statutory costs in there. You know, hopefully they're fixed at this point in time, but you know, there is a reality that these professionals are going to need to be paid across the life of the development. So you know, it's ensuring that there's sufficient costing in there, and usually these type of costs can normally be formalized before you even go into the deal.
That's true, and I think that's a really important point here, is that these are evolving, and when you're running through any project, you go through so many iterations of the financial model from an initial headline assumption, and every quote you get, whether that's from an architect, an engineer, or every step you progress, those numbers become more realistic and more accurate. And so with this, we're able to easily add in additional costs, tweak these other costs, or remove them if they're no longer relevant. And something we say to a lot of our customers is to set up a template with all of the costs that you could imagine or that you typically see on projects, just to have them there as a prompt. So even if you're not, even if there is no specific, I don't know, a landscape architect, for example, on this project, because there's no landscaping, it's in there as a prompt just in case there was and you hadn't included it. So we always advise people to set up a template on that basis to avoid missing things out and then having to go back to your funder looking for more money or having to adjust the finance proposal at a later point in time. All right then, so moving on from the other costs, I'm going to skip over this tab here for finance and jump over to the site purchase information. It's worth mentioning at this point as well that in Aprao you can jump around and complete this information in any order. So you might start with your purchase price because that's known. Equally, if you're running a residual appraisal, working out how much to pay for a site, then this is a great way to do it. You start with what you think you can sell on the site, how much it's going to cost you to build, any other costs associated with that, and then finally the site purchase. I'm just going to point out this residual site value tool at the moment. So you can set a target return. So let's just say our target return is 20% on cost. We can also change that to return on GDV, but I'll keep it on cost. 20% on cost there. What that does is it factors all of this in, so like the legal fees on the purchase, it automatically calculates the stamp duty based upon the existing use class, and then it will give you a residual site value. So in this case, the residual site value is 2.709 million. But we've actually got £2 million in for the purchase price because that was what was agreed theoretically on this site. So the £2 million here and this residual value here shows us that this site is being purchased at a good price. Obviously, if this figure here was higher, if this was £3 million, you would see that the residual value is 2.7 and our key metrics, because our target return was 20%, and our return on cost is actually showing us 13% now. So obviously there's not as much margin in the development, which would make it harder to fund. So if I just take this back down to our 2 million, you can see all of these metrics update real time. Bear in mind, we don't have any finance in the mix yet, but you can see that the return on cost at the moment is 41%, which is obviously fantastic. Around the site acquisition side of things, Daniel, is there anything that you want to highlight?
I think I generally use this part in any sort of appraisal as a bit of a sense check. I mean, 9 times out of 10, the purchase price is agreed. So from our perspective, we're that's already finalised, or it's certainly been negotiated with the landowner. But in terms of the sense check, I would generally look for circa 20 to 25% return on cost for any scheme that lands on my desk. If the return is wildly out, perhaps it's coming at 35%, that's when I start asking questions. Those questions are, is the GDV too high? What's most likely the build costs are too low, so that's therefore adding a bit more profit in the project. And if those elements can be sort of justified from the developer's perspective, we have to look at, is it the fact that you're just buying well, or you've added value through the planning system? So there are variants to that, but as I say, if a profit and cost is coming in, 30% plus, there's generally a reason for that. Because if you're buying on market and your build costs are right, your sales are right, it's going to be too good to be true, and they generally are. So that's when my sense check comes in, and I think, well, perhaps we need to be looking at a sort of higher build cost, or as I say, maybe the GDV is a little bit too high.
That makes sense. All right there, Daniel. I think let's say in this case that the developers managed to have a bit of planning gain, and that's where we've got a great profit margin going on here. So once you've done all of that information, our software automatically generates a format of report, which I'll just share with you quickly, because it's very good to see. Let me just share this. Okay. So this report here that is automatically generated from putting in that information covers all of the clear information on the project. So this was born out of my lending background, where I was receiving appraisals much like Daniel does every single day from people looking to secure finance. Every appraisal is coming in a different shape, format, from 3 lines to 30 pages. And the real desire here was to create a standardized format which covers all of those data points. So going through that process, obviously without us speaking, you can appraise a site literally in a matter of minutes to get to that residual site value or to put some numbers together. And then when you're ready to present something to a lender, this report, which can either be shared by link or exported as a PDF and sent over to the lender, is able to give them all of that information that they want. So I'll just give a very quick run through, and we can share a link to this afterwards so anyone can see it. But the summary financial, the cover page here has got the site address, the site location map as a satellite view to show the built environment. We've got a project summary here. And then we've got the actual summary financial appraisal. This is basically your one-pager giving you an overview of the entire project. We've also got the key metrics all highlighted at the bottom down here, the IRR, the return on equity, return on cost, return on GDV, and the all-important profit figure. And then we've got this breakdown. So this is where Daniel was saying about seeing all of that information of the pounds per square foot from a sales perspective, and that's really useful. So we've got a summary table of all of the units, and then we break it down on a unit by unit basis, by unit type. We then have site purchase information, which the existing use class here, all of the stamp duty and fees and everything broken down. We've then got the full build cost breakdown. We obviously did that as a relatively high level, but if you did a full breakdown, that would be covered here as well. All of our other costs. And then finally, we've also got a sensitivity analysis. So this is a great tool because this looks at what happens if the GDV goes up or down, and what happens if the build cost goes up or down. So 0% sits in the middle with our 40% margin. If the build costs go up by 15%, then we're looking at 33% percentage return on cost. And if the GDV drops by 15%, then we go down to 13% return on cost. So really useful tool to look at the risk profile of the project. So what we're going to do now is we're going to assume that this has been sent over to Daniel looking to secure finance. I'm going to go back over to Aprao, and we are going to talk about what the typical terms would look like and what Daniel's looking for. Let's start with the experience and the borrower profile, and then what that could mean from a terms perspective. So Daniel, over to you, looking at what you'd be looking for from a typical borrower from an experience perspective, and then we'll go into the typical terms for a project like this.
Okay, thanks, Daniel. I mean, from our perspective, it is all about track record. So as supplementary information to come over with the appraisal, is demonstrating experience, demonstrating track record, and that's project specific information, and own account development experience. I see a lot of experience or developer CVs that point towards being a contractor for the last 10 years, but that doesn't sort of really fit the bill in terms of policy for particularly for close brothers. So just getting that experience point is very important in terms of the information that we see, because there's no point of us specifically giving terms on a deal if the track record doesn't really sort of tick the box. In terms of additional information on top of that, current exposure as a developer, the likelihood is you're probably borrowing money elsewhere. So we just want to get a sort of overview idea of what you're doing, who you're borrowing from, what your LTVs are. Again, that just gives us an overview of your sort of financial ability. Up-to-date accounts, management accounts, again, helps us assess where you are financially. So, that they're the sort of additional supplementary pieces of information that we would want to see initially on top of an appraisal such as this.
Okay, and then when it comes down to the key metrics, so before we look at the terms, do you want to just highlight, is there anything over here on the right where, what are the numbers you're looking for, the sweet spot or the kind of that minimum threshold for you to be able to consider a deal for financing?
Yeah, I mean, I mentioned earlier that ideally you're looking for anything between sort of 17.5% and 25% return. I mean, obviously if it's a higher return and there's an explanation behind it, then fantastic. But that sort of 17.5% to 20% return on cost after finance is sort of a good starting point, because we want to make sure when we're going into the deal that there's some value in it and it's worthwhile for the client. When we work out our sort of metrics in terms of LTVs, we generally lend anything between sort of 50 and 60% of GDV and averaging around the midpoint. When we work our calculation out, we have allocations to ensure that we fund 100% of the build cost. We want to make sure that the day one that we put in is no more than circa 60% of the value of the site. So therefore, the rest of the money going in is the borrower's money, and that should always be at least 10% of cost. Now, if mezzanine is not being brought in, that criteria is hit quite readily. I mean, our rule of thumb return on cost for a circa 60% of GDV loan will be anything between 80 and 85% of cost. If you tag mezzanine on top, that's when the sort of figures start pushing towards that sort of 90%. So then that's where we need to sort of assess where the 10% of cost is going in. Now, whether that is cash or whether that is planning gain, the key really is to ensure that the developer has some form of skin in the game.
Okay, then. Well, look.
Yep. Go on. And then, and as I say, it generally comes back to that return on cost metric as well.
Okay, yeah, so that's all important. That's why it's up here in the top left-hand corner, in the pride of place on the appraisal. So let's take a look at this project then. So we've got currently everything's being funded by the developer's equity as it stands right now. So the total costs are 4.6, and that's being funded by the developer's equity, which can be shown down here. So zero borrowing, 100% funded by the developer. Now we're going to add a lender into the mix. So let's say this is a example deal that you're looking at, Daniel. Let's have a look at what your typical loan to value would be for this then. Can you hear me, Daniel?
Yeah, breaking up a little bit, Daniel, sorry.
No worries.
For this example, let's put it in at 55%.
Okay, so this is 55% of GDV, which is coming in at 79% of cost. So it's in this scenario here that would be within your sort of standard parameters that you mentioned. Are you able to give just a rough idea of what a typical interest rate would be for a project like this?
So as a gross rate, I would suggest 6.5%.
Okay, and that's obviously per annum. And then I'll make an assumption on this project, or I've actually already done a cash flow, but of 18 months to acquire, demolish, build, and then sell those units, which gives us a estimated interest cost. But Daniel, as far as I understand it, you would typically run a cash flow and indicate a interest allocation back to the developer. At which point we're able to actually build that into the model here, where we can override the interest figure if you give a interest allowance back to the developer like that. So it's worth mentioning at this point. Oh, we've got the fees as well. We can't forget the fees. So you're able to give just a rough indication of what these are likely to be. Are you able to give a rough indication of what these are likely to be?
Yeah, so for 18 months, the commitment fee would be 1%.
Okay. Is that of the loan amount, Daniel?
Yeah, sorry, for on 18, 1%.
Mm-hmm. Okay, and
that's of the loan amount.
Yep.
And the exit fee, we just, for simplicity and just put it in as 1% of the gross development value.
Okay, then, so 1% of the GDV. So we've got a commitment fee in and our exit fee out. Just then, so what that's now allowed us to do is actually to factor the senior debt into this project. So you can now see that the return on cost has now come down to 33%, factoring in the interest cost. And so those key metrics, it's important that you're looking at them. I'm guessing, Daniel, correct me if I'm wrong, but you want to make sure that it's still hitting those numbers once the finance has been factored in. I think we've got a bit of a slow connection there, but I was just saying that you want to. Am I correct in saying that you want to see that the return on cost is still hitting those metrics even once you factored in the costs of the finance?
Yeah, very much so.
Perfect. All right then. All right. Well, now with this, I'll just mention a couple of bits as well that are particularly powerful with Aprao. So we've just estimated the interest cost here, which on 18 months assumes an S-curve over those construction costs and equates to 181,000 in interest. We've used Aprao to actually produce a cash flow. We've got this smart cash flow tool, which is very, very easy to use. Just to give you an example, let's say we want to factor in the build cost of our 4-bedroom houses, and we're going to start building them on month 3, and it's an 8-month construction project. We can then choose whether that is a straight spread or we can spread those costs over an S-curve. And the cash flow tool will automatically factor in a full S-curve over the construction and factor in the drawdowns. So we're able to quickly and accurately estimate the interest costs on finance. The cash flow also factors in the project's IRR and then the equity IRR. So that's the geared and ungeared IRR. So if I jump back over to the finance, I can now change the interest calculation method to the cash flow. And I can see that based upon my actual drawdown requirements, the interest figure is actually slightly lower than the length of time that I had allowed for with the estimated cost. But as we mentioned before, when going into a project with senior debt, it's likely that the lender will allocate a proportion of the facility to cover interest costs, at which point you're still able to factor that in by using this override feature in the appraisal. So now we are nearing the end of the run through of the project. So you now have an understanding of what of your project, what the profit's going to look like, what the residual site value is, what the finance costs are going to be. You've shared this information with your lender, let's say Close Brothers. They've been able to come back to you with quick feedback because you clearly displayed and presented those terms. We're going to be opening up some questions in a minute. So if you want to type your questions in the chat over on the right-hand side, there's a little icon at the top right of the Google Meets interface with like a speech bubble. If you click into that, you can actually type your message into the chat function there. Whilst any questions are coming through on that, I just wanted to highlight as well that we are going to be sharing Daniel's contact details after this as well. So if there's any developers who are looking for finance, then they are able to get in contact with Daniel and Close Brothers. We are also offering anybody on the call a 14-day free trial of Aprao, and we'll be sending out a link for that as well, which I highly recommend giving a go if you haven't already done so. I know we've already got quite a few customers on the call anyway, but for those of you who are not, it's definitely worth giving it a go. So now we don't have any questions through yet, so surely somebody's got a question out there. Here we go. So Tom Whiteley has said, any thoughts on lending for modular, gents? So Daniel, I'll let you answer that one.
Well, that's a question to start with. Thoughts on modular? It's quite a difficult one, to be honest, because as we know, modular is built in a factory, and the larger the scheme goes, or the larger the scheme is, it's more difficult to fund, because as a financier, we're working on the basis of works that are certified and actually on site, so built and delivered. So with modular, the money is potentially locked up in a factory and being constructed. So unless you can sort of cash flow the release of the modules, it can become quite difficult, because there's been a lot of talk in the market around potentially finding an insurance product to cover the stock or the WIP that is sitting in the factory. But we all know that insurers will do all they can to wriggle out of paying out. I'm sure we've all had experience of that. So it's one of those areas that still needs some work. I think we're all mindful as funders that it's potentially the future. So we need to sort of continue looking at ways that we can work with developers in terms of delivering the modular product. My experience with modular so far has either been modular delivery of bathrooms, pods within a more standard build, or more SIP factory type construction, where you can cash flow out of the factory and deliver, and it's built more like in terms of the panels going in, so you can control the WIP that is delivered on site and fixed. I sort of have a lot of question marks about those sites that are being delivered within a factory. If you get to a size where it starts becoming efficient for the developer, it then becomes more of a challenge for the financier.
Okay.
Hope that answers.
I think that was a pretty good answer. It sounds like there's a need for a bit of innovation in terms of, like you said, that insurance or dealing with that WIP. And Tom says, interesting, thanks. So we clearly answered Tom's question. We've got another question that's come through from Michael Sharpnell around, and this is actually around Aprao. So, and this is, he's asked if we're able to incorporate multiple finance rates. And this is actually a good opportunity to show, because yes, we can. So let's say we're building out a finance stack with multiple lenders in the mix. Let's say we've then got a mezzanine lender. We can add as many lenders in as we want. So here we add a mezzanine lender in. We'll just call them a mezzanine lender for now. Let's just say they're providing 750K loan on the project. this is likely to be interest on the full loan amount. Let's just say it's at 1% per month, for example. So just to show a different type of interest. This again will be out for 18 months. We've got the interest factored in here. We can choose whether it's retained, rolled up or serviced. And then we can set any fees on that as well. So let's just say 1 in and no exit fee. So now what we've got is we've got Close Brothers and we've got a mezz lender. We can see the developer's equity here has dropped a bit too low. So the mezz, maybe we'll bring down the mezz to £500,000. We'll bring that in, and now the developer's putting in 12% of total development costs, or 11% including the finance costs. So yes, to answer your question, Michael, we're able to factor in as many lenders with different interest rates and types of interests as you would like. The other thing as well, we are also able to factor in profit shares as well. So if you've got a lender who's on a profit share, not just on an interest rate, we can factor that in with, let's say, a 20% share of the profit, for example. So it's a very flexible finance module. Hopefully that answers your question. Just if anyone else has got any other questions, feel free to add them into the chat. Whilst we're seeing if anything else comes through, Daniel, I just was thinking of a question. Given when I was a lender, I think it was really important to manage people's expectations from a timescale perspective. When people were approaching me looking for finance, are you able to give a bit of an indication of what the typical timescales are for securing finance from somebody maybe sending you an initial project to look at?
Yeah, that's not a problem. In terms of responding to the appraisal or an opportunity, we'd like to think that we'll be back with you with at least some early feedback within sort of 24 hours, 48 hours. That will start sort of conversation point. Once we're at that point, it then comes. I mean, we're in a different world now. So back in the day before COVID, the key would be agree a sort of in principle terms over email or over the phone, and then I would then try to head out to site, see the specific site, and to look at, we talked about track record earlier. I'd want to come out and have a look at the sort of the developments that you had already undertaken, so we can sort of put some meat on the bone, if you like, in terms of that track record. And then once those terms are agreed and we've had that first meeting, we can have a decision within a week. We have credit committees in our diaries Monday, Wednesdays and Thursdays, but because of our short reporting line, we can actually get decisions on any day, to be honest, but we try to keep a structure to when our credit committees are. Once a decision's made at credit committee, and those decisions are made all in-house within our office in London, or at the moment all online, a facility letter will be with you within 24 hours. Then it will come down to how quickly you do that facility letter, return it with the initial fee. And then, as Daniel was saying, we need to then be realistic about timescales. Generally, it's driven by what the client wants to achieve. If you want us to complete tomorrow, that's probably going to be a bit of an issue unless we've done a lot of pre-work. But I always say rule of easily within 4 weeks. But that's driven primarily by the professionals. How quickly we can get the professionals out on site, how quickly we can get those reports turned around, and that is driven by the information of the professionals, and also, how quickly the lawyers work together in terms of turning around. We have examples of schemes that have been completed within sort of 7 to 10 days, but I've also got examples of loans that can take up to 6 months and beyond. So there is quite a wide breadth of those schemes that can, in terms of the delivery. But I think it's more about everyone pulling together. If you want to turn it around quick and everyone's pushing in the right direction, it will happen.
All right then. Thank you very much for the answer. I think that gives a nice overview. We just had another question come in from Michael, which will take as our last question, which is from a valuations perspective. They tend to run. This is a question really covers for both of us, but I'll let you go first on this one, Daniel. But valuers tend to run 100% debt finance models. What's your view on this, given that it's not the reality of the market? Did you get that, Daniel?
Sorry, Daniel, you broke up quite a bit there.
No worries. So the question was that
no, I didn't know.
Valuers tend to run 100% debt finance models. What's your view on this, given that that is not the reality of the market? Okay. If you open your chat, Daniel, you should be able to see it. But from my perspective, I will be able to give a quick answer of that. And I think that, you know, as a valuer, it's very hard to know exactly what the typical terms are for every deal out there. So there needs to be a standardized approach. So I do feel like assuming 100% debt is unrealistic for the majority of projects, and does not fairly represent the true finance costs. But what it does allow is the ability to compare projects on a like-for-like basis, or create that standardization from a valuation perspective. I also know that there's been a few legacy tools prior to Aprao that have been that the functionality has been more limited to being able to calculate accurate interest costs. So the 100% option was always an easier to go through option. Daniel, Joyce, can you hear me now? I'll assume that's a no. So
yeah, you know, I've read Michael's question. Okay. Hopefully you can hear me. Yeah, just on that point. I mean,
yeah.
Can you hear me, Daniel?
Yeah, I can. There's just a slight delay.
So I've read the question. I mean, in answer to Michael's comment, you know, it is unrealistic. It is unrealistic to look at 100%, but I think, as Dan alluded to in his comment, you know, it's more about comparing like for like. You know, so if someone's reviewing it on a 60% basis versus 100%, you know, you're not comparing like for like. So I mean, from my perspective, we're generally looking at the GDV, because that's the driver for our metrics. And how that works back to the land value, you know, we can have a debate at that point, and then it's up to the developer to decide whether they are comfortable with the outcome of the residual valuation. So it doesn't have a great impact on the considerations we have in terms of our lending, unless our loan is very highly geared against the land, which generally it isn't, because in our policy we ensure that our gearing is controlled at that point.
Perfect. All right then, that was a good answer. Michael says thanks. Right then, I think we are on our time that we scheduled of, well, we're over 45 minutes now, so we'll take this opportunity to wrap up. I just want to say a massive thank you for Daniel, Joyce joining us today. Really appreciate your time and your input into this. And if anybody has any questions following this, feel free to send them over, and we'll be able to write a piece of content to follow up on answering those questions. We'll also send the email out afterwards with the ability to sign up to our trial for Aprao, and also with sharing details of how to get in touch with Close Brothers on the finance side of things. So again, thank you from me, and yeah, thank you for joining. We're going to be running a few more webinars over the next few months, so keep a lookout, and we'll update you when those are coming out. So thanks again, and thank you to Daniel, and everybody keep safe, and we'll speak soon.